Hey everyone, welcome back to my channel, and I hope you're having a wonderful day so far. If you're a student, I hope your finals went well, and today we'll be talking about investments and portfolio management. But before we get started, please make sure to let me know in the comment section if you prefer these kinds of videos or parodies. So first, you might want to know where you can invest money and what a portfolio even is. Well, to start off, a portfolio is essentially where you store your money, whether in cash, in real estate, or in the stock market. A portfolio is constituted of all of those things. Here's a list of where you can put your money, sorted from high liquidity at the top to low liquidity at the bottom. Liquidity is essentially how easily you can get cash from an area where you put money. So some highly liquidable portfolio components include cash, savings, and certificates of deposit, while some portfolio components with low liquidity are real estate and bonds. Liquidity is something you should factor in when you're saving for the future. For instance, if you're buying a home, you have to take into account that you're probably not going to sell your home for a few years, and that it's pretty hard to sell a home when you're deciding where you want to put your money. Essentially, how quickly do you want to liquidate that component of your portfolio? So now let's talk about risk and return. You've probably heard the saying, no risk, no reward, right? Well, this is basically a principle of finance. The higher the risk, the higher the return. So over here, you could see the definitions of beta and bond investment grade ratings, right? Beta is basically how volatile or risky a stock is in comparison to the S&P 500, which is a selection of 500 stocks in the stock market, while bond investment grade ratings are essentially beta for bonds. They're how risky a bond is. Now let's look at an example for stocks. So here we have the Yahoo Finance information on Tesla stock as of yesterday, valued at $695 at the time the screenshot was taken. Here you can see that their beta is 2.15, right? Right here. So basically, Tesla stock changes 2.15 times as much as the S&P 500 does. So let's look at the one-year chart for Tesla stock. You can see that it's decreased quite a bit, right? Like within a year, it went from 86.08 to 695. That's a pretty large increase. I think that's almost 800% return. So in other words, Tesla stock has very high return, right? So what can you infer about the risk from this? The risk is really high, right? So basically, whenever you hear that something has ridiculously high return, then you always want to be careful about the risk when investing in it. We mentioned earlier that bonds have something similar to beta known as the bond investment grade ratings. So if you take a look at this chart found in Investopedia, thank you, Investopedia, you can see that high risk bonds are known as junk bonds, while lower risk bonds are known as investment bonds. Junk bonds are much riskier than investment bonds, so you should keep this in mind when considering investing in bonds. So now let's talk about diversification. Essentially, you've always heard like you should never put all of your eggs in one basket, right? Well, that's the principle here in finance. You should not put all of your money into one type of investment, whether it's a high risk investment or it's all in real estate or it's all in cash. You should try to diversify your portfolio as much as possible. If you're wondering how you could do this, I'd suggest two different ways. The first being to manage your own portfolio and to choose a variety of areas in which to invest yourself, which can be done through a platform like Robinhood. I'd only recommend doing this if you're an expert in the sense that you know what you're doing. But if you're a newbie, then the second would be to invest in a basket of stocks, whether it's in S&P 500 stocks or the total stock market index fund. They're both great options, and it's up to you which you decide to choose. So remember, now is the time to invest. Now is always the best time to diversify your portfolio. If you're young, actually, you can incur more risk when you're investing because although the stock market fluctuates in the short term, it grows over time. So this ensures that your money will grow over time. And remember when investing to save and then spend. So thanks so much for watching. I hope you've learned about portfolio management and diversification through this video. Please feel free to check out my channel if you like this video, and I hope you have a wonderful day. Bye.